Hey, it's Sean with CV Wealth. Hey, I want to talk a couple minutes about the volatility that you've been seeing. And I've been thinking about how it impacts you and your plan. Big picture, let's talk about zooming out for a second. We're pulling back from a really strong run in the stock market. Since 2022's bear market, have been on a multi-year strong run, multi-years of 20 plus percent. The other reason that we're seeing some choppiness right now is, a couple of factors. One, profit taking. After 2 years of 20 plus percent returns, it's natural for people to take profits. It's healthy, especially for retirees who are looking to, set some cash aside for future expenses. The other thing is that over the last couple of months, with the government being shut down, there's been some delays in critical data points that are now starting to come back out. And whenever there's delay in data, when that uncertainty releases, it creates chop. Not that that's right or wrong, it just creates choppiness. So, it doesn't mean that we're forming a new top or this is the catalyst for a downturn. It's just chop and it's normal. The other thing that has changed in the last, say, week or so is the outlook for the Fed in cutting interest rates. And what I want to remind you is that the stock market is like a 4-year-old child. It will throw a temper tantrum when it doesn't get what it wants. And unfortunately, right now, the market wants the Fed to cut. And the data underneath with these delayed reports is showing that the economy is somewhat healthy. Yes, we're starting to see the jobs are not as great as we'd like them to be, not as weak as the Fed would need them to be to support aggressive rate cuts. And so we're in this tug of war of, well, how bad does the labor market need to get to aggressively cut rates versus just a slow cycle? And now we're seeing big firms like JP Morgan, Morgan Stanley, Goldman Sachs, all coming out and saying they see more gradual rate cuts. And the Fed futures this week also projected a cut for the December cut, now below 50%. So while it's really good news for the economy, it's less exciting for traders who were pricing in a Fed cut in December. And so it's really important to remember, hey, we can't have our cake and eat it too. And that's why we're seeing this volatility in the market. There's a lot of talk about an AI bubble. We have people like Jeffrey Gundlach and Ray Dalio coming out saying, yes, there is an AI bubble. There may be, there may not be. We don't know. But we are seeing signs of froth. I've talked about that in the past. I don't disagree that things got very optimistic very quickly. But these times of volatility are really healthy. They're very healthy because it shakes out some of the greed that seeps into the market. Go back to Wall Street and Michael Douglas, greed is good. That stuff needs to get shaken out every once in a while. We watch what are called the 50, the 100-day, and the 200-day moving average. These are trend lines. The 50-day is the short-term mood of the market. The 200-day is the long-term direction of the market. The 100-day, obviously, is kind of the in-between. And right now, major indexes are below their 50-day lines, but still above their 200-day lines, meaning that this is a classic correction inside of an uptrend. This is normal and healthy. It shakes out some of the leverage. It forces some of the late cycle greed out to reset. And to me, it's one of the great things that helps prevent bigger market bubbles from forming. So yes, the market is throwing a bit of a tantrum right now. It wanted instant cuts from the Fed. It didn't get them. Add profit taking, some messy data, some noise coming from some talking heads about AI bubble, and here we are, volatility. It's to be expected. But from where I sit, this still looks like a traditional volatile correction after a very strong run and not the beginning of a classic downturn. If this volatility has you on edge, let's talk about it. I don't think any money that you need to spend in the next 6, 12, 24 months, it shouldn't be in this market. It's too volatile. There's too much going on. But money that you don't need for 10 years, 20 years, I don't think it should be on the sidelines. There's too many good things going on in the underlying market. The economy is healthy. Corporations are making money. There's too many good reasons to be invested right now. So just my take. I hope this helps. If you have questions about how this relates to you, your retirement plan, and your portfolio, please reach out. Have a great day and have a great Thanksgiving.